right. Good morning, everybody. It is Valentine's Day, and I love you all, man. Friday, February 14th, 2020. I am in Puerto Rico. Spent a few days in San Juan, and now I'm in Rincon on the West Shore. And I will tell you, if you have not been here, it is beautiful. It has all the hallmarks of being in Puerto Rico. You go through good areas and bad areas, places that still have storm damage, others that have been rebuilt. Not unlike driving through the Florida Keys, actually, last year that I did a show from. But I think that if you have a chance to come to Puerto Rico and spend some of your money, I'm trying to trill my R's, and see what's going on here, I will tell you at the outset of this call that that I look for alternative investment ideas. And that is one of the things that we look at is, okay, what are private equity firms doing? What are venture investors doing? What are hedge funds doing? What are the big money, smart money people doing? And how can we benefit from that? Well, I will tell you, if you are looking for a second property, you might want to look at Puerto Rico. Here's why, or a third property. One, the tax code is amazing. So if you would decide to live here 6 months plus a day, you could get amazing tax breaks. But the island itself, on the northern half of the island, from the east coast to the west coast, not really a lot of impact from the seismic activity in the south. I would stay away from the south, and I think a lot of people are going to move out of there. However, make sure that everybody here is muted. But from east coast to the west coast, northern part of the island, I think there's a lot of opportunity. Clearly, it's an island, and it's going to get hit by hurricanes, and you have to build and factor that into your equation. But I think that there are amazing investment opportunities here, and I have a whole list of reasons why. Take a look at John Paulson, billionaire investor, and some of his reasons. A lot of mine overlap his. I do ultimately think that Puerto Rico becomes a state eventually. I think there's a set of circumstances that would lead to that. And at that point, 5 years, 10 years, 20 years out, assets here, real estate here, businesses here become worth a lot more. So if you have a truly long-term time horizon, right, you're not coming here to flip real estate. But if you have a truly long-term wealth-building time horizon and you like being in Puerto Rico from time to time, possibly half the year, it's actually something I've considered, then it could be somewhere for you to look. This is way different than, say, the other alternative investments we looked at, which was buying truck stops. That happened to lead us to making an investment in TA. So, we bought Travel America stock, and it promptly doubled. That was something that I probably should have pounded the table on harder. However, I will tell you, on pullbacks, Travel America is still something that I'm looking at for new clients and looking for spots to get investment letter clients who missed into that stock, because I think that ultimately the C corporation structure offsets all the management concerns, which turn out, without the structural problems, to be very positive. So I do like Travel America going forward, but there's a certain price point. Yeah, I don't think I'd buy it at 16 or 17, but certainly, lower double digits, 10, 12. We get a pullback, Fibonacci retracement, I think that that's something to look at. So, alternative investments. What's the most popular alternative investment? It's gold, right? Everybody always talks about gold. You have even your crypto anarchists and Bitcoin Austrians and all the other people who push Bitcoin. What are they calling it today? They call it digital gold. Well, I'd rather own the real thing. I'd rather own the companies that dig the real thing. Why? Because it's real. Bitcoin, we know, has the problem of being largely controlled by the Chinese and Chinese corporations. Take a look at the wallet. Take a look at how the computing power, the hash, how everything works. The Chinese use Bitcoin to launder money out of the country, and now they largely control it. And when there's a breach, who do you think ends up with that money somehow? So I stay away with Bitcoin because much like gambling, poker gambling on PokerStars and other non-sanctioned, non-regulated websites, Bitcoin's going to have its come-to-God moment where a lot of money disappears. And it's happened in batches already, but ultimately Bitcoin's got a huge security risk based on the concentration of the power that comes with Bitcoin. And we've already seen it start to come down, and now we're getting a rally. But take a look at that chart. Bitcoin is going to around $1,000 per Bitcoin, probably less at some point. And the only way it really actually survives is if it's adopted by a large portion of the population as some sort of a store of wealth or a unit of exchange. Right now that hasn't happened. It doesn't look like that's going to happen. But with gold, real gold, it's been accepted for thousands of years. It is a store of value. It's a real thing. And it's used not only in the old economy for jewelry, which people are always going to like jewelry. My girlfriend asks me for hardware. You know, she doesn't necessarily need to get married, but she wants some hardware. And, you know, there are central banks out there that are buying gold. There's a chronic demand in the system. And now the new economy is starting to use gold. Apple is the largest owner of gold in America. Private owner. Did you know that? Now you do. So Apple actually uses it as a component. So I believe that there is a massive gold bull market coming in the 2020s based on the mergers and acquisitions that we've seen in the industry, quantitative easing that we've been seeing for a decade, the potential for modern monetary theory money or helicopter money. I hope we don't get MMT, but it's in the realm of possibility. So, after a period of fixing balance sheets, right-sizing, de-risking, gold companies are poised to expand their profits in the long term. And I want to talk about something that we've talked about before. Oligopolies are good for investors. Why? An oligopoly means that there are fewer competitors. Largely, they all know what the others are doing, and they control pricing. Now, theoretically, that's what was supposed to happen to oil recently, but the oligopoly got busted because demand is threatened. Now there's a substitute for oil. Hence why we've soured on oil. That sour, get it, sour oil. With gold, there is really no substitute. Bitcoin's not going to be a substitute. And we've seen massive consolidation in the industry with Goldcorp and Newmont Mining merging. Now we have Newmont Goldcorp, which is the biggest gold producer in the world, and also Barrick Gold, which bought Randgold. So those two companies, Newmont and Barrick, control a little under a third of the gold production on the planet now. That's a lot of power, much like another oligopoly we like, which is in fertilizers. Not many fertilizer producers out there, potash in particular, but also phosphates and nitrogen. But I focus on potash because you have to mine that to get it out of the ground. And with climate change, we are going to need more and more nourishment for our soils. So with gold, we have the basic supply and demand. I would point you to history, though, real quick. So let's take a look at what gold did years ago. Back in 2000, 2001, gold was one of my investments, and it went way up. I wrote an article in 2012 saying that the leadership in gold was over and to sell your gold. Over the next couple of years, the price of gold dropped 40%. Right in here is where I became constructive on gold again after a few years of basically, you know, five years of ignoring it. Started to nibble in, and last year we got more serious about gold. the consolidation in the industry is not just with the big players, but it is moving into the mid-sized and smaller players. One of our subscribers brought up Kirkland Gold, which I started to look into. I don't know that I'll buy the company individually at this point. However, I like that it's in the gold miners ETF that I'm recommending, and that I think should probably be a core holding and not just some satellite holding. You know, a lot of people talk about, have 5% of your money in gold. I think that if you're below 10% at this point, you're probably too low. So I think a 10 to 20% weighting to gold stocks and physical gold is probably the way to go. I'll talk about physical gold for just a moment at the end. But in general, I like the gold stocks because they are levered to the gold prices. What do I mean by that? Most of the low-cost gold producers produce gold for around $1,000 per ounce. Some a little lower, some a little higher, but let's say around $1,000 an ounce. At $1,500 an ounce on the market, you can see that that's a huge profit margin. If some things occur that we'll cover here in a second that can drive the price of gold higher, now a lot more money drops to the bottom line. These corporations have, for the last 7 or 8 years, not only right-sized, but they've delevered their balance sheets, they've cut their debt, and now with the mergers, they're cutting their operating expenses, but producing just as much gold. So again, think about this in terms of margin and leverage and where you can really make money. So a corporation that increases its margins and its profits is going to make more money than just the naked price of gold going up. So even if the price of gold goes from $1,500 to $2,000, which I think is very likely, and from $2,000 to $3,000, which I think is very possible, I would anticipate the price of gold is $3,000-ish a decade from now. So roughly a double. But I think that gold stocks like Newmont and Barrick and Core can triple. Why is that? Because of the huge drop of profits to their bottom line, and then the implementation of a valuation there. So supply and demand for gold has been roughly unchanged for a pretty long time. So here we are taking a look at gold demand. It spiked on investments during the boom. Then as the gold bull market ended and turned into a bear market, you can see the green boxes here, which is investments, shrunk. And now investment is starting to grow a little bit again. Central banks are having a little bit of the action. Technology, which I just talked about, Apple, right? This is likely to grow. And jewelry, with the expansion of the middle class globally, is likely to grow. So this levelness here, it looks a little jittery, up and down year to year. I would expect that to rise, and I think that you're going to see demand for gold get up to around 5,000 tons per year by the end of the decade. So this line should probably expand up to about here. And then here's your gold price line, and that'll also go up, and I think get to about 3,000. So I think you're going to be looking at about 5,000 tons of gold demand by the end of the decade and a price of around 3,000. The companies are going to do the best with that. Here's the supply equation. It's very difficult. Even at the peak here, when there was more gold to mine, they couldn't get to 5,000. So they're going to try. They might be able to get to 5,000 by the end of the decade. Right now, demand slightly outpaces supply. I believe that equation will flip where demand will slightly outpace supply, right? Right now, supply outpaces demand. I may have said that wrong. Supply slightly outpaces demand right now, and I think that will flip so that demand slightly outpaces supply, and it could be by next year, but for sure within several years. What are some of the reasons that the demand for gold could go up? Well, we talk about just the expansion for jewelry among a growing middle class. You also have the demand in the technology sector, which is likely to continue. But here are some other reasons, and we'll come back to the junior minors in a second. Aging demographics, government budgets, and stagflation. You're going to want to read this. I'm going to put this article out on the free website probably Monday. I have another link or two to put in here yet. But aging demographics are driving everything economics, along with technology. Even the deaths that we have today are driven by demographics. If we didn't have aging populations in Japan, China, Europe, and America, our budgets would be much, much closer to balanced. However, this curve here should wake you up to the fact of what's going on. Velocity of money is what dictates the economic activity. Notice, as the population has gotten older, velocity of money has fallen. That relationship is held true forever, and it'll hold true for the next 20, 30, 40 years as the baby boomers move into their sunset years. Right now, we have something along the lines of 10 million baby boomers per year in America retiring and moving out of the workforce. That's a huge number. Think about that in terms of the total population. That's 3% of the population retiring every year. Now, we're replacing some of those people, but not all of them. So that is going to drive down economic activity. So not only do we get slower economic activity, but we get bigger deaths because of Social Security and Medicare. We know that about 3/4 of baby boomers have nothing substantial saved, and that's going to ultimately become a problem. It's already a problem, and it's just going to get worse. By 2035, Social Security technically will be insolvent, and we need to understand what that means. It doesn't mean that there's no money there. It just means that what's going into Social Security versus what's coming out becomes a negative number. Right now, we're running deficits on Social Security, so we've already gotten to the point where we're pulling more out of Social Security than we're putting back in. Now, Social Security is a hypothetical thing almost because there really is no trust fund. It's just IOUs from the federal government. So the IOUs from the federal government essentially will be used up by 2035. To fix Social Security, we're going to have to raise the retirement age and probably change some things around. Social Security is only underfunded. See if I have this in here, easy to find. Social Security is only underfunded over the next 75 years by about $15 trillion. I have suggested that we print the $15 trillion and put it in a lockbox, much like Al Gore has said a long time ago. Put that $15 trillion into the lockbox, invest it in U.S. government bonds, and let it actually be an investment. At that point, start putting 1/4 of contributions from Social Security into the S&P 500 or the Russell 2000. You have to figure that out. Build equity in the country versus debts. There are smart ways to deal with Social Security that are actually relatively easy if there's any political will, but they all require money. So if we have a situation where we do print the money, you're going to have people screaming hyperinflation. And I pointed out before, it's not hyperinflation if the money trickles in over 30 or 40 or 50 years through pension checks, through Social Security checks. So I believe that we should print somewhere in the neighborhood of $20 to $25 trillion, bail out Social Security, bail out the public pension system, and throw a couple $1 trillion in there for student loan forgiveness and and the seeds of a Green New Deal. I believe a lot of these things should be done differently than what's being proposed by the extremists, but there are ways to do things that solve problems, and that's what we should focus on, solving the problems, not just papering things over. Modern monetary theory, which is another idea that's out there, is to just keep printing the money as you need it because, hey, if you print it in your currency, it doesn't matter, and that's bullshit. We're in an interconnected global economy. Currency strength matters. And as scarcity returns because of lack of investment, you're going to want a stronger currency. So what we should be focusing on, not as QE, which has led to asset price inflation, but no extra economic growth, right? The tax breaks that we just got did not create economic growth for more than a couple quarters. QE has not created any excess economic growth for a decade. All it's done is raise asset prices. Well, eventually, if we just keep printing money so that investors, we keep doing QE so investors do well, what happens to the 60 to 80% of the population that gets no benefit from that? That is a social construct problem that we had better face up to because one day it becomes too hot to handle. That's why Bernie Sanders is starting to jump into the lead, is because he is discussing these things in a way that appeals to a lot of people. His solutions might not be the best. I don't believe they are. However, he's pushing an MMT platform. However, we have to accept that it resonates. So if we don't steer towards the better solutions, somebody else is going to steer us towards worse solutions. And that's another reason gold is a strong investment. If we get modern monetary theory, that's going to devalue the currency. What happens when we devalue our currency? Other nations devalue their currencies. It becomes competitive devaluation. That's something else that I talk about in these articles. So we've already gotten QE for longer. And if we get modern monetary theory, we're just in a phase of competitive devaluations. Again, bullish for gold. So the supply-demand equation for gold, let's review, is bullish. But all these monetary and fiscal policies are either more bullish or super bullish for gold. In my opinion, we might see the biggest gold stock rally in the history of gold stocks over the next decade. Because I don't have faith that we're going to do everything right, at least not the first time. Remember Winston Churchill, Americans do all the right things, but after they've tried everything else? I'm very afraid that we're going to go through a try everything else phase. If Bernie Sanders becomes president, bars the doors, we're printing money, baby. But we're not going to solve problems, and that's my problem with Bernie. So I don't think he solves all the problems. I think he knows who the bad guys are. I think he knows what the problems are. I just don't think he knows what the right solutions are. So ultimately, I do believe that helicopter money is inevitable. So we're going to talk about Milton Friedman here for a little while. Not, in my opinion, the best economist to ever lived, but he made some very important points. He talked about inflation, always and everywhere, a monetary phenomenon. If there's more dollars in the economy, that will ultimately create inflation. Right now, we're seeing it in assets, certain assets. But we're not seeing it in our everyday prices of our goods and services every day. Certain things we are paying more for. But there's a surplus of food, so that hasn't gone up yet. Eventually, more dollars means that they're less valuable. That's only common sense. If you say I have $1 million of something, and somebody else says that they have $2 million of something, is the million worth more or less, right? It's very simple math. More of something in a supply-demand equation makes it less valuable. Helicopter money is another Friedman idea. We last heard it with Ben Bernanke, Helicopter Ben, and it basically means that you print money, you drop it into the economy hard and fast, right? A lot of money at one time. Now, if we do that and don't direct it properly, it does in fact become hyperinflationary, which was what the Austrian economists worry about. Yeah, I have a pretty chart for that somewhere too. Maybe not. Austrian economists would point out that we'd become like the Weimar Republic or a banana republic. We just print money. Money has to be used for productive purposes. That's what we should always take away from whether we're studying a company, an industry, or a full economy. If money is used for productive purposes, generally things work out. But if it's used for shopping and hoarding, it's inflationary, and that's bad for standard of living. Inflation is always bad for standard of living. So what we have to be concerned with is how do we use the money that eventually gets printed? Because I would bet my life, actually, that we do helicopter money during my lifetime. Probably in the next 10 years, and we might get the first bout of it soon. My concern is that we get modern monetary theory. Why is this all important? Because these are all scenarios that point to more money in the system, devaluing of currencies. Certain things will be worse for the dollar and better for gold than others. The supply-demand equation for gold is positive. QE is starting to pump up gold. Modern monetary theory would probably pump up gold the most. Helicopter money applied poorly will probably pump up gold the same way that modern monetary theory does. I mean, the two are almost indistinguishable. But helicopter money used properly to solve structural problems in the economy would be bullish for gold and better for the economy, which might be bullish for gold to boot. So we're looking at a situation where in the next decade, the scenarios for gold are not bullish or bearish, but bullish or more bullish. I suspect we're going to get the more bullish because I think we're going to screw up a couple of times before we start fixing things. Maybe I'm wrong. Maybe somebody starts to fix things in the next several years. We haven't done it for a decade. President Obama prevented a depression, but what's going on right now is setting us up for some very bad things. The impact of the tax cuts is not permanent. We have seen through history from JFK all the way now to Trump, that tax cuts are never a permanent solution. They had the most impact under Kennedy because tax rates were coming down to very, very high levels. Now we're screwing around with 2, 3, 4, 5% in either direction, not cutting taxes, by 30, 40 points, which is what Kennedy did. So these ideas, the tax cuts today are the equivalent of what we did in the 60s are silly because the scale is so much different. The tax cuts that we just got are already wearing off. They did not lead to higher GDP. $3 to $4 trillion of wealth has transferred from 99% of the population via debt that's on the national balance sheet into the hands of the 1%. Again, that's driving political ideas. And sometimes the swings from one side to the other side get extreme. And that's why I'm concerned that we see the most bullish scenario in gold that's out there, which would probably be modern monetary theory. If that happens, there will be good places to invest your money, and that'll be to wherever the money flows to, and one of those places will be gold. Technology obviously will also be there, alternative energy. We know where the new economy is going. We've discussed it several times. But there's a possibility these gold stocks, which are way off their highs, triple, quadruple, quintuple, in the next decade. They need to be part of your asset mix. They also are a hedge against what if we screw up really bad and we move towards not trying to get out of these problems. What if we decide to absorb a depression to force out all the bad debt? We could do that. We've seen austerity fail recently. We've seen austerity fail years ago. Austerity doesn't work. Just like printing money doesn't work. There's the in-between solutions that we don't like to do because it doesn't cater to the base on either side. So us centrists are left to watch and say, okay, I'm a step left or I'm a step right, but I'm close to the middle, close enough. But what if we get the extreme policy? We're seeing extreme policies now with the tax cuts that are driving $1 trillion deficit. What happens as the population continues to age? Trillions and trillions more of unfunded liabilities. The only solution is to print money somehow, and then to use it properly. As I said, we'll probably print money and not use it properly and have to try again. That means gold could go into the stratosphere. I'm not discounting the possibility gold goes to $10,000 an ounce on speculation. So at some point, maybe this year, I probably will buy actual physical gold as a hedge against a Bernie win, right? But gold is also a hedge against deflation because we know that it's done pretty well during deflationary periods. So you really don't have a lot of losing scenarios with gold and gold stocks in particular. Why? Especially if you buy the baskets. You know, you can always make a mistake on a company or management can let you down or a project doesn't work and it has an impact. Take a look at Boeing. Great company. Management let them down. The 737 MAX fell apart, and now that company's got major problems. I still think it's going to drop another 30%. At that point, I probably want it because, hey, they're part of the duopoly in those, you know, in jet engines, but in jets. I want you to take a look at this chart before we really sum up it and get going here because I've got a pool to go hang out at. You hear President Trump talking about inflation being at its lowest level in generations. That's true. Didn't start under him, right? You know, it was already at a pretty low level when he took office, and it's gone lower, and that's great. But a lot of it is on the juice from the tax cuts, and not really from jobs moving back onshore. It's a lot of service jobs at the low end that are being filled. Now, as we've talked about a number of times, there's about 6 million jobs that are more skilled that we're not training people for. If we really wanted to keep unemployment low, we'd figure out a way to take 6 million people who are unemployed and say, look, let's put you in a 2-year program, get you trained with some of these more skilled jobs. And obviously, 1 million of the jobs are engineers, so that's longer than 2 years. But most of the 6 million jobs out there are 2, maybe 4-year programs. And then we have a more skilled labor force and a more secure labor force, a more secure job situation. What do we know every time unemployment got really low? We got the double dip recessions here. Unemployment low, recession, unemployment low, followed by recession, unemployment low, followed by recession, unemployment low, going to be followed by a recession. That recession will trigger the next wave of monetary and potentially fiscal policy. And that'll be bullish for gold. So you should be looking to buy the dips on gold stocks. And at some point, we may want to buy gold. So here's the very quick takeaway. Right? We're already in Newmont Mining that we bought at the merger in the low 30s. We sold covered calls because, as I discussed, the way the merger was structured, there was an arbitrage opportunity at the time. It went away, but our calls expired. And then our cash secured puts also expired because the stock rebounded as I told you it would. So now Newmont Mining is 35, 40% higher when you figure in the premiums 30% higher just on appreciation. Barrick Gold, we've talked about. We're not in, but I think it's worth taking a look at. One of the subscribers brought up Kirkland, which initially I thought was a joke because my name's Kirk. No, I'm just kidding. I knew what Kirkland was. But they're going through a merger. They just bought somebody, actually. I covered that in the article. And they might be somebody we take a look at. I don't think so. I think it's just a good component in the index. But maybe. I have to analyze their projects. And then core mining. We've owned core mining since, right around $5 we've been buying it. But we bought more of it lower. And a couple of us made really good call trades. So a word about junior gold miners. People always want to speculate on the junior gold miners. The gold bull market that ended in about 2012 started in about 2000. It wasn't until the very end that the juniors jumped up. So if you take a look at these two ETFs, even with the juniors having a huge outperformance at the start, they've underperformed over time. The mid caps and the large caps are where the action is for gold. Now, will there be a trade in individual gold miners or possibly the index 7, 8, 9, 10 years out when FOMO gets a hold of everybody? Quite possibly. But I want to own the big companies and the mid-sized companies. They have great balance sheets. They have great profits. They have great projects, and they are showing discipline. The mergers are driving lower operating expenses, but the gold production stays up. That's a great equation. So if you're going to buy a junior, I don't think you want to buy the basket. I don't think you want to buy GDXJ. I think what you want to buy are companies that you think have a simplified business plan, easy to understand, great management, solid balance sheet, and then in my opinion, they have some sort of transformational asset that's already being developed and about to drop money to the bottom line after the initial expenditure period, right? Those initial expenditures people confuse with, forever expenses. They're not. When they first dig the mine, that's the most expensive part. So as those expenses plummet and then revenues come in, you start to see these jumps in profitability for certain companies. That's what you need to look for in junior miners. Companies that are near the end of a high expense period of getting something off the ground and about to start dropping money back into the buckets. That's where core mining is. So their silver tip project is a big deal. They've gone through the transition and they're starting to rise. So bottom line is for now, we want to look for opportunities to buy GDX, the Van Eck Gold Miners ETF. The easiest one to buy on pullbacks. You could try to buy Barrick or Newmont, sure. I don't know that I'll be adding to those except on more significant corrections. But GDX, in my opinion, has become one of the few buy-the-dip investments out there. So anytime that you see an oversold or approaching oversold level, and you can see the money flows that are continuing to go up, those short-term pullbacks are buys. And Newmont and Barrick are like a quarter of the index anyway. So when you can buy those when you can buy GDX on a pullback, I think you should do it. I think you want to gradually, over the next several months, maybe a few quarters, get to a point where you're somewhere between 10 and 20% gold stocks, probably closer to 10 than 20. Wait for the bull market to really take hold so that you're not sticking your neck out too far like I did with oil stocks. Be careful out there, all that sort of thing. But I think you build a position up to 10% GDX, and if you're going to own some stocks, that goes into your gold allocation too. So if you own the stock and the ETF, maybe you are 15, 16, 18% gold stocks at some point. I think that's to the high end of the range. I think that 10, 12, 14, 15% is probably your better asset allocation. So I'm going to take just a couple of questions, and I'm going to get rolling. I go hang out with my Valentine. So, gold streaming companies, take a look at the dividends. They really don't do anything special. The miners are where the big money is. So I know people talk about the streamers, and it's a gimmick, just like MLPs and yield cos and other types of synthetic investments are. I don't think that, and if you compare the streamers to the actual producers, it's an easy equation to see. The producers outperform the streamers. I mean, from time to time, you can find a company that's got the right math, but not in general. Somebody says that they've been selling puts on GDX. Yeah, I love selling puts on GDX. If you already have like a 4, 5, 6% position in GDX, and you want to just keep selling puts a dollar or two out of the money until it finally gets put to you, I think that's a wonderful idea. Wonderful idea. And the volatility on GDX is high enough that you do get a couple of percent, every month. So you can really make somewhere between 15 and 25% a year just selling slightly out of the money puts a month or two out on GDX. It's a pretty good strategy. And because you have a basket there, it's not as high risk as doing it with one company that could have a fall off the cliff problem. All right, I'm just going to finish this up with SunPower. Two people mentioned SunPower, it looks like. I still love them long term. I think they're in the right spots with commercial development, followed by residential development, and they're still selling to the utility developers. I like the split off that they're doing. I like the new investments. Somebody pointed out the Total sold shares. It looks to me, because I read one SEC document, that has to do with the Chinese investments and the split off of the new company. So I don't. I think the SunPower is another one that you sell puts on. And in fact, I have some orders outstanding to sell $8 puts for March. Sierra Wireless, somebody brings up. No, the problem with Sierra Wireless is that there's just better companies out there. I think they're a good company, but I think that they missed their opportunity to really jump ahead, and now the competition has caught up. So they had an opportunity 2-3 years ago when we first talked about them to do really well and get ahead of the game. For whatever reason, it didn't catch. They're still all right. They're still going to make money. Are they going to beat the index? I don't know. And I compare tech companies to QQQ. So I don't want to own a tech company if I don't think it's going to beat QQQ. I'll buy QQQ, and then I'll look for my home run stocks. I don't think Sierra Wireless is a home run stock anymore. I think it's a good company. And the way that I really look at investing is you have your core, which is generally QQQ and a couple of other ETFs, and everything else that you put around them either better generate a very good income that's growing or have the potential to be a home run. And if you have a lot of income going into the portfolio on top of a core that beats the S&P 500, and then you have a few home runs, you're going to win. Hence why I talk about always avoid the middle of the market. I think Sierra Wireless is a good company, but they're in the middle of the market again. I thought they might get ahead. They didn't. Move on to the next home run idea. I hope that makes sense. And, okay, so I'll finish with Invesco, not the ETF, QQQ, but Invesco, the issuer, the bank. I think that that's paying a huge income and has very limited downside. And there's potential that they grow quite a bit. So as a dividend grower with low downside and a little bit of upside, I like buying them on pullbacks too. What's the dividend on that? 7-8%? That's worthwhile. That's a big fat dividend that's very stable, and the potential for downside there is very low. Even in this pricing environment, they're doing well, and they're fourth biggest, so they're not going to disappear. They might even get bought, right? We just saw a big transaction in telecom where 3 bought 4. Who's to say that Invesco doesn't get together with number 3, right? You got iShares, which is BlackRock. Spider is 3 or 6. I don't know. I'd have to take a look. But who's to say that Invesco doesn't merge again and get more traction with their products and lower expenses? I think that you probably see Invesco in another M&A deal. We've seen them in several, so why would you think it's going to stop? So I don't think there's much downside in Invesco. I think the dividend is stable, it's growing, and I think that they probably engage in more transactions that unleash more value in a consolidating industry. We should, as investors, we should like consolidating industries. We may not like them as consumers all the time, but as investors, consolidating industries are our friend. All right, I'm going to let you go. Have a great Valentine's Day. Put your questions in the Ask Me Anything threads, whether it's at Seeking Alpha or Fundamental Trends, Margin of Safety, Investing at Seeking Alpha. And I will get to those with some quick thoughts. But again, today was about alternative investing, mainly gold, but we brought in some other ideas. If you haven't traveled to Puerto Rico, I tell you what, I had middling expectations, and those have been blown away. And I'm about to meet with 2 people who have been introduced to me to talk about investing opportunities. I don't think it's right for everybody, but I think it's right for somebody. So you might want to take a look down here. The tax code, if you are able to live here for 6 months in a day, and I'm not sure if I can or I can't, but if you're able to live here for 6 months in a day, the tax breaks are off the chart. So keep that in mind as well. All right, have a great Valentine's Day, and I will be back in Milwaukee next Friday. Hopefully it's not still 0 there. I'm enjoying the 85 that I got here. All right, take care, everybody. Happy Valentine's Day.